All right, so we have a new topic here, capital structure. Though we hinted at it before, we looked at EVA, and there's two parts to economic value added. There was the return on capital, what we made in economic profit, and there was the cost of capital. So what we want to focus now here on this part is the cost of capital. Is there something we can do about this split between debt and equity so that we can reduce the cost of capital and thus increase the economic value? We want to do it in a way that it doesn't harm the rest of the business, but this part of the business, how we fund between debt and equity, shouldn't affect anything else. We're adding interest expense back, so if we use more debt, we have more interest expense, but less equity you have to pay back at 8%. So it seems pretty obvious if debt only costs 5%, but equity has an 8% cost, and obviously we would want to do a lot more debt and a lot less equity, but it's not quite that simple. So as we walk through this, very, very important theory in finance. Hopefully maybe you went out and read a little bit about Modigliani before you did this session, give you some background. It always helps in understanding a new complex topic to have some background before you see it in the class itself. But let's see if we can make this easily to understand. So first of all, this is like one of the most important things in the entire class right here. There's two ways to increase the value of the firm. One is to increase the free cash flows of the firm. That is, get this economic profit higher. That's one approach. The second approach is you reduce the risk of the firm and thus reduce its cost of capital. So if you reduce the cost of capital, the firm value goes up. Why? Well, just think discounted cash flows. We're going to do stock and bond valuation later. When you reduce your discount rate, your present value goes higher, and so the value of your firm goes higher. So just by reducing risk and reducing the cost of capital of the firm, the value of the firm goes higher. So there's one approach, is to just change your mix between debt and equity. Can we just, hey, if debt costs less, why don't we just load up on debt? We're going to find that that doesn't quite work because of the impact it has on equity. We've actually already talked about it before, and maybe it'll make sense as we get into it and say, hey, wait, I already know this. The second thing you can do is just reduce the firm's risk by reducing its beta. If you remember the capital asset pricing model, the cost of equity, that 8%, is influenced by the firm's systematic risk or its beta. So if you reduce its beta, make it a less risky company, less cyclical, less dependent on the economy, then you will reduce its cost of capital, increase its value. We are going to focus on this first one. We won't focus on the second one, but when we get into valuation, you'll definitely see its impact. So is there something we can do between debt and equity such that the WACC of the firm goes down and the value of the firm goes up? So when we're looking at the capital structure of the firm, first we have to ask how much capital does it need? And then the second question, which is this approach here, is should that capital be allocated? Should we borrow money or should we issue equity? So this first question is how much capital do we need? That is the funding question. So most firms hope that they can fund all of their needs with internal funds from their retained earnings. We call that kind of firm self-sufficient. They don't have to borrow money. They don't have to issue stock. They can fund all of their operations with just the cash flow of the firm. I think firms like Apple are like that. Apple and Google and Microsoft, they produce tremendous cash flows. They really don't need to borrow money. They really don't need to issue stock. In fact, a lot of them are buying their stock back because they have so much excess cash. Maybe not right now during the coronavirus, but in normal times. For some industries, how much net worth a firm has, they may have more funds than they need, but management is holding extra funds just because they want to be ready for a crisis like what we're in right now. There's a lot of firms who did not do that. They're buying a lot of their stock back. They were borrowing money, and many of y'all saw that in your first paper in Project 1 where you did a financial analysis. You saw your firm was buying a lot of stock back Some of them were actually issuing debt to buy their stock back. Well, those firms are probably in a lot of trouble right now. But some firms are more cautious, and they'll have extra funding just as a cushion in case something goes wrong. We're going to talk risk management later, so we'll get into that. But funding needs are how much cash did you produce? What are your working capital requirements? If those goes up, that's going to be a problem. And then what capital assets do you need to buy? Buildings, machinery, those type of things. Your external funds are your funding needs minus what you produce internally. You could look at it as change in cash plus a change in working capital requirement plus a change in fixed assets minus your change in retained earnings and depreciation. So we actually add depreciation back because it's a non-cash item. I don't really care if you learn this formula. It's not an important formula. We already talked about working capital requirement. We did that in project 1. It's your change in inventories, change in receivables, change in prepaids, minus your accounts payable change, minus the change in accrued expenses. Change in fixed assets is those acquisitions that you need, expenditures, and the next class we'll talk about business combinations, so even acquiring other firms. So if a firm needs external funds, the capital markets will do that for them. That's where I worked, in the capital markets. Capital markets are those who bring borrowers and stock issuers together with those who are investors, who are savers. So you have financial services firms like banks, investment firms, insurance companies, and now we even have crowdfunding. These are firms who are bringing these investors and borrowers together. You also have institutional investors like pension plans, endowments, and also, to me, I worked for an investment firm and ran a pension plan and ran an endowment. So we were actually the people who were investing money, bringing those savers together, and we were going out and investing the money of those savers so that they could have a return. Households historically would make funds available through banks and insurance companies and their retirement plan. The question is, are people borrowing more or are they investing more today? And usually corporations were the ones that needed funds. So the traditional approach is households would be savers and corporations would be borrowers. Today, the world's all a little bit out of norm. You have people in China that are savers, but Western countries tend to be spenders, and so it's a little bit out of whack right now. But the traditional approach is households provide funds. They work through a financial intermediary like a bank or an investment firm or their retirement plan, and that provides funding to the financial markets. So how capital markets work is you have deficit units, those who have a need for capital, and they're bringing them together with those people with excess funds. And financial services industry, they're known as financial intermediaries because they're between the savers and the borrowers. The banks, insurance companies, investment companies, the actual exchanges themselves, and governmental entities. Banks can be money center banks, regional banks, community banks, credit unions, savings banks. Each of these have their own incentives, their own sources of capital, their own tax rules, their own regulators. I have a class on both life insurance and life and health insurance companies and property and casualty insurance companies where we talk about their special needs. So we talk about investment firms when we talk, or we talk about a little bit more when we talk about stocks and bonds here a bit later. The players are consumers, and governments have excess funds to provide to corporations. That's no longer the case. Now we have a lot of corporations with excess funds. We even have non-U.S. countries like Russia or China that have excess funds that are investing. But even that's a little bit tricky because China, there's a lot of debt in China that's a little bit scary right now. So the world's a little bit out of whack. And this may all come to a head here in the next 5 or 10 years, or even the coronavirus might show us who are the people who just went too far with their debt. All right, so let's talk markets. You can read this paragraph on your own. Um, so who are these providers of capital to corporations and even to individuals? So we have primary markets and we have secondary markets. The primary markets you as a retail investor will never see. These are markets where they issue new securities, they borrow money for the first time, or they issue stock. If they do this for the very, very, very first time, especially issuing stock, it's known as the initial public offering. We've seen some of those. In fact, some firms like Spotify and others have been doing some interesting things where they've been actually avoiding the primary markets and doing things directly. Very interesting things going on in the market right now. The initial public offering, that's like what Facebook did a few years ago when they went public. They issue stock for the first time. They do this in the primary market. And large investors like pension plans and endowments and insurance companies, they'll participate in that market. A season issue is firms who are issuing stock or borrowing money for a second time or third time or 50th time. They've already gone out to the markets, the primary markets, some years ago, maybe even 100 years ago. Now they want to issue more stock and want to borrow money. They're now in the secondary market or secondary issuance. The secondary market this is where we're trading securities. So the secondary issuance and the secondary markets are not the same. Secondary issue are people who are borrowing money or issuing stock. They're not doing it through the secondary market. They're doing it directly with investment banks and going out to large institutional investors. But the secondary market is where we trade. These markets do not provide cash to firms. So if I go to my broker and I buy Apple stock and it costs me money, but Apple doesn't receive any cash. The person who receives the cash is the person who had Apple stock and they sold it to me. So secondary markets do not provide any cash to markets, to corporations. So we execute through organized exchanges. More and more of these becoming electronic. And in fact, there was a news article that the New York Stock Exchange has shut down because of COVID-19, and yet people are still trading because everything's electronic. So even without human people in the exchange, they're still working because most markets now are electronic exchanges. We still have markets that are over-the-counter markets, and over-the-counter markets, these are large institutional investors, sophisticated investors. There's no trading floor, but this is when you do block trades of $50 million, $100 million, mainly in the bond markets where you have very sophisticated investors. It's hard for us as individual investors to actually buy individual bonds. These are just large markets. We can buy individual stocks in the secondary market. Individual bonds is a little trickier. These tend to be over-the-counter markets where you have a sophisticated buyer, a sophisticated seller trading with each other. You have stock markets, you have fixed income markets. Stock markets are very liquid. You have constant price discovery. You have some confidence that the price you see in Yahoo Finance is the true price you could get today. Fixed income markets tend to be over-the-counter markets. They're much less liquid. You don't have the same price discovery. I talked about this in the Investment Society meeting a couple weeks ago, where bond prices are not. A lot of bonds are not priced every single day because they're not traded every single day. They're traded in over-the-counter markets that are much more thinly traded, and so you can be pretty shocked. Your mutual fund might say they're down 1 or 2%, but they may really be down 3 or 4% because we don't really know the actual true price of these bonds. Some companies do private placements, which mean they avoid the public markets altogether. They're over-the-counter. Again, it's just an example of an over-the-counter market where a sophisticated investor is told by their broker that, hey, this firm is borrowing money. They don't want to go through the primary markets. They want to go through a private placement. And so a big pension plan might come in and say, hey, we'll do $100 million of that, and we'll go directly. They avoid SEC registration, SEC regulations by doing registration with the SEC that allows them to do things without all the requirements of the Security Acts because they promise only deal with large, sophisticated investors. On the debt side, you have junior issuance and senior issuance. Junior issuance will give you a higher rate, a higher interest rate, because if the firm goes under, you're going to lose all your money. There's no collateral there. Whereas a secured debt, there's collateral. You have access to the firm's assets. A good example might be Delta Airlines. Obviously, the airlines right now are very dangerous. Their industry is under incredible stress, but they can still borrow money with secured debt by securing the debt with their planes. So they say, hey, if we cannot pay you back, you get our planes and you can sell our planes. So that's the secured debt. Whereas if you did a junior unsecured debt with an airline or a cruise line right now, it would be really dangerous because they just may not be able to pay you back. So secured debt would have higher credit ratings. Remember credit ratings in Project 1. So the same entity, Delta, might have some debt that's single A rated because it's backed by their airplanes in a trust, whereas they may have double B or even single B rated debt because it's unsecured, no collateral. If firms, corporations want to borrow short term, they use commercial paper. These tend to be high quality companies. Small companies that are not very sophisticated or not very well known by markets, they tend to do all their short term borrowing directly from banks. But large corporations that are high quality, they can do commercial paper, very liquid market, very low interest rates. And then you have line of credits, which back to commercial paper. These are banks that say, we'll step in. If you cannot borrow in the debt markets, we'll step in and we'll loan you money. If it's committed, you actually pay the bank a fee. And when you pay that bank a fee, they're promising you they'll loan you money if the credit markets freeze up. Right now, we're in a place where credit markets are under a lot of stress. Late part of 2008, the credit markets froze up. Firms that needed to borrow money could not borrow money because almost no one was lending money. And so if they had a committed line of credit, they could go to their bank and borrow money and essentially have access to cash when there was no other places. I'm not going to talk about leases, but leases is a way to essentially borrow money in a collateral way using a special operation called a lease. If the accounting rules are changing, we used to have operating leases and capital leases. Operating leases was essentially you're renting something, you didn't really own it. Whereas a capital leases, you were really buying it on debt, but you were setting it up as a lease. Accounting rules were very complicated. But if you look through, if you're an accounting major, you'll have to learn the new rules for operating in capital leases. What I like about the accounting is they're moving essentially everything to a capital lease. That you put the asset on your books and you show the debt on your books. So if you're leasing a $50 million piece of equipment, you put a $50 million asset on your balance sheet as an asset, and you have $50 million in debt as a liability. I like that approach a lot better. It's much more realistic to what's really going on. All right, so in the next session, we'll get into the second question. Should the firm use debt or should the firm use common stock? So we'll start there in our next session. Very famous theory. So again, if you haven't gone on and read Investopedia or Wikipedia about Miller Modigliani, here's their names right here. If you type those in, you might want to read that so you get someone else's perspective before you listen to my session. I think that would work a whole lot better. All right, so next session we'll be getting into Miller Modigliani, a really famous theory in finance.